Okay, hello everybody. In this video, we're going to talk about the circular flow of income. First of all, we realise that the world can be quite complex, and in order to understand it, we have to a way to try and simplify things. One way to do this was with a model. We make a simplified version of reality, and if we can understand this simple version of reality, we can gradually make it more complicated and more realistic, and then we can understand actual reality a bit more. So from biology, rather than trying to understand everything about a human body, if we can understand some basic parts, then we can gradually understand how the human body works and make it more complicated as we study it a bit more. Same with economics. We can begin with a model, and if we understand the model, we can then begin to understand other things. So the first model we'll look at here is the circular flow model, which is a visual model of the economy showing how money flows between households and firms. Be two actors in this model, households and firms, in two markets, the market for goods and services and the market for the factors of production. Remember, the factors of production are the inputs that lets us produce outputs, and they are labour, that's human effort, land, all the gifts of nature, capital, which is man-made inputs that lets us to produce more goods and services. So it could be buildings and machines, or tools, equipment. It could be a tunnel or a road or a power plant. Goods that aren't final goods for consumers, but goods that allow us to produce more goods and services. We'll classify that as capital. And enterprise, which will be the decisions and organisation and risk taking by entrepreneurs and firms. So land, labour, capital, enterprise will be the factors of production, or the inputs that allows us to produce outputs. So in the circular flow diagram, we're going to have households and firms. Households are assumed to own all the factors of production, and they then either sell them or rent them to the firms in exchange for income. They also buy the goods and services that the firms produce. Firms buy the factors or hire them from households, use them to produce goods and services, and then they sell goods and services to the households. So we've got the market for factors of production. And in this market, households sell labour and land and capital enterprise to firms, which firms use as inputs. Households don't give up their labour or the other factors for free. They do it in exchange for an income. So when households give, say, labour to firms, firms in exchange give wages to households, which will be the household's income. Same with all the other factors there. When households give land and capital and enterprise, in exchange, the landlord will get rent. In exchange for capital, there'll be interest. In exchange for enterprise, there'll be profits. And each of these places, there'll be a household at the end of it. So when money is given for land or for buildings, will ultimately go to a landlord who will be a person. Same with enterprise. Ultimately, profits will go back to the shareholders who own the company. So ultimately go to people or households. And in the market for goods and services, households are the sellers and firms are the buyers. Households sell the factors and firms buy them off of households. When households get income, they can then use this to take it to the market for goods and services where they can spend. And in the market for goods and services, households are the sellers. Households, forgive me, are the buyers and firms are the sellers. Firms sell goods and services in exchange for income or revenue. So firms sell goods and services. The households buy the goods and services that firms sell, and that will be then revenue for the firms when they sell goods and services. And with that revenue that they've generated by selling goods and services, they can then use this revenue to pay for the factors of production, which will be wages, rent, interest, and profit, which then go back to the households as income. And when the households get income, they can then spend in the market for goods and services. They can then buy goods and services, which will then become revenue for firms, who can then in turn buy factors of production, wages, rent, interest. They can buy the factors, which will be land, labour, capital, enterprise. And to get labour, they have to give over wages. For land, they have to give up rent. Capital, they have to give interest. And for enterprise, they have to give the owners over profits. So this outer flow here, the green flow, will be the monetary flow. So the green flow is the monetary flow, which shows how money flows between households and firms. And the inner flow, which is red here, will be called the physical flow, which shows how goods and services and factors of production flow between firms and households. So firms produce goods and services, which are then sold in the market for goods and services and bought by households. Households have got goods and services which can keep them alive, which is good because then they can give the factors of production to firms in the market for factors of production, where the firms buy the factors off of households. They then use them to produce goods and services which are sold in the market for goods and services to households. And that red flow then is the physical flow. So there's two flows, the physical flow, which is the inner flow, and the monetary flow, which is the outer flow. So we can see these two flows here, one with the green, one with the red. To make the model a bit more realistic, we can add in some new sectors. So we can say in the real world, there'll be a role for the government and for the financial sector and for international trade. So in the real economy, there's the government who spends money and collects taxes. There's a financial sector where people save and where people can borrow from to invest. And there's also international trade, which is when companies buy goods and services abroad. They either buy and sell goods and services that are made abroad, or companies at home can produce up goods and sell them abroad, which are called exports. So with each of these sectors, we can identify an injection, which is money being added into the circular flow, and a withdrawal, which is money being taken out of the circular flow. So with the government adds to the circular flow when it spends. When this government spends money, for example, in increasing teachers' salaries, or if it spends money building a new building, then it has to spend money. And one person's spending is another person's income. So when the government spends, income is going to go up. So the government injects money into the economy when it spends. However, the government is able to spend in part because it raises money in taxation. Taxation is money collected from households in the form of VAT or income tax, or from corporations in the form of corporation tax. So government collects taxes, which reduces the amount of people have. So the taxation will be a withdrawal. When the government taxes people, it takes money away from them, and it's money leaving the circular flow. As well with the financial sector, if people save, then that's money not being spent, and it's money not going round the circular flow because people aren't spending, so firms don't have it as income. If they don't have it as income, then firms, if they don't have that money, they can't then spend it on workers or on capital or an enterprise. So when people save, it's a withdrawal from the circular flow. It's money being taken out. When people save, they often save into a bank. And when people save into a bank, part of the bank, when the bank gets the savings, part of the thing they'll do with it is make investments. So they'll give loans to businesses with those savings. And those businesses can then expand and buy more capital and buy more equipment and expand their operations. So when people save, that money is leaked out of the economy, but it usually leaks out into a bank, and the bank then can inject it back in the form of investment when it makes loans to different prospects. So an injection from the financial sector will be investments, and a withdrawal from the financial sector will be savings. Lastly, there's international trade. There's imports and exports. Imports are goods that are produced abroad and sold domestically. Exports are goods that are produced domestically and sold abroad. So if we take iron brew as a classic example of a Scottish export, if someone in America buys iron brew, the goods exported and it's leaving, but the money's coming back into Scotland, so it's going to be an injection. Exports are an injection into the Scottish circular flow, whereas if someone in Scotland decides to buy a can of Coca-Cola, that's going to be made in the United States. So that money, the goods coming in, which is why it's called an import, but the money is leaving, which is why imports are withdrawals. So when people buy Coca-Cola, the money goes back to the United States. So if we can analyse each of these sectors a wee bit more, we'll look at government spending and taxation. If we look at taxes, where the government received money, it received most of its money in the form of income tax. This is 2019-20. So almost 340 billion raised in income tax. VAT, 136.6 billion. So income tax and VAT combined make up more than half of all the government's tax revenue. Corporation tax, the next big one, then council tax, business rates, fuel duty. So including these main taxes, it makes up almost 2/3 of all government tax revenues. If we look at where the government spends, again, this will change over time, but from 2019-20, 130 billion was spent on health, 63 billion on education, 29 billion in defence, state pensions, 101.3 billion for pensions. We spent more money on pensions than we did on education and defence combined. So these are all places where the government spends money. And if the government spends money on, say, a state pension, then it's money being injected in. So it's money added into the circular flow, and it's going to boost national income. If we look at the composition of taxes, we can see the government in 2019-20 it spent 840 billion, but only received in income tax and taxes, all taxes, 811 billion. So that meant the government, to finance its spending, it had to borrow. So the government had a deficit of about 29 billion pounds in 2019-20. When the government spends more, it raises in tax, there's a deficit. If taxes are higher than spending, there's a surplus, but the UK government's not had a surplus for quite a long while. If we look at how the deficit has changed, again, it's a percentage of national income. It was just under 2% in 2018-19, just over 2% in 2019-20. Then we get to 2019-20. So we get to 2020-21, and the deficit goes all the way up into the heavens, way above 16%, to one of the biggest deficits, indeed the biggest deficit we've ever had outside of wartime. Question is, why did the deficit rise so much in 2020 and 2021? The answer we know is because of Corona, which meant all the shops were shut. And as a consequence, people couldn't spend. When people couldn't spend, firms couldn't generate an income. Because people couldn't spend and firms couldn't generate an income, the government wasn't able to generate any taxes. It couldn't generate corporation taxes because companies couldn't make a profit. And it didn't get very much from income or national insurance, and income tax or national insurance, because quite a lot of people were made unemployed because their employer wasn't working, their employer wasn't employing, and there was no work for them. But the government did decide to spend it, so it had less taxes coming in. In order to ensure people had an income, the government ran the programme to spend money, workers' wages. So it spent about 200 billion or so, paying lots of workers 80% of their salaries. It was called the furlough scheme or the job retention scheme. So as a consequence of having a lot less tax coming in, still maintaining existing public services like the NHS and education, and also spending a lot on lots and lots of workers' salaries, the consequence is the government had to borrow a massive, massive amount in 2020-21. We look at exports and imports. Exports are goods that leave the country, but they generate income abroad, so they're injections into the circular flow. Examples of the UK could be Iron Brew for Scotland, whisky, oil. One of the biggest and most important exports for the UK is financial services. Imports are goods that are produced abroad and sold domestically. That means money is being withdrawn from the UK circular flow. So examples, if it's a cheap plastic toy, chances are that it was made in, where. If you buy an iPhone, it was made in the United States, or at least it was The company that generates the income is in the United States, Apple. And if you buy a Mercedes, then that's obviously going to be German. So when we look at exports and imports together, they'll make up the trade balance. And in the UK in 2018, we exported less than we imported. And a consequence was we've got a trade deficit of about £30 billion. Look at where exports go. Most of them, just over half of our exports go to the EU, with Germany being the biggest export destination, followed by China, United States down in fourth. And we look at saving and investment. Savings when someone saves money that's not being spent. So people aren't going to save money. If people aren't going to spend money, then they're going to save it. And when people save it, it's a withdrawal from the circular flow. So they could save into a savings account or a credit union or the stock market. And that's money being taken out. So because people aren't spending that money, it's a withdrawal. And because money is being withdrawn, the consequence of that is it's not going to generate revenue for firms. And that in turn can mean firms might be able to hire a bit less. At the same time, if people save into these places, the money can be used. If they save into a bank, it can be used to finance other things. It can be used to fund businesses if they want to expand. So the money that people save into a bank can also finance investment. So it could purchase new equipment, new premises, or new machinery. Or the government can borrow some of that money to invest in new structures like schools and hospitals, roads, bridges, tunnels. And that will be an injection. And if there is an injection by building, say, a new tunnel, then that improves the economy's capital stock. And that might allow us to produce more goods and services over time because people can travel a bit more easily between different places, which means, say it's a delivery driver, they can easily get between different points, say different sides of a river. So it can improve the amount of goods and services we can produce overall because people can travel to different places. So if we go back to the circular flow with all that in mind, we can update our diagram as such to show injections into the circular flow and withdrawals out of the circular flow. So this diagram here shows households and firms, the two flows, the monetary flow and the physical flow, and it shows injections and withdrawals. When injections equal withdrawals, the economy is in equilibrium. If injections exceed withdrawals, there's an expansion, and withdrawals exceed injections, then the economy is contracting or getting smaller. Okay, so that's a rough overview of the circular flow and the different components that make it up.